March 4th, 1929. Washington, D.C. The air is cold. But the mood across the nation is anything but. Today, Herbert Hoover becomes America's 31st president. Standing before a jubilant crowd, he makes a solemn promise. We have reached a higher degree of comfort and security than ever before. I have no fears for the future of our country. It is bright with hope. His campaign had ridden a wave of extraordinary prosperity. Republican flyers promised, boldly, a chicken in every pot and a car in every backyard. The American dream seemed not just achievable. It seemed guaranteed. But as the jazz bands played and the crowds cheered, no one saw what was coming. Black Thursday was exactly 6 months away. During the month of Hoover's inauguration, one number dominated Wall Street. 381. An all-time high for the Dow Jones Industrial Average. For 9 straight years the market had climbed. It had grown sixfold since 1921. This relentless rise made investing look like a guaranteed sure thing. And the fever spread. Far beyond Wall Street. Factory workers, restaurant owners, waitresses, even shoeshine boys were putting their daily tips into the market. One prominent analyst declared with total confidence that the market had reached a permanently high plateau. Steady gains, effortless profits. It was the ultimate illusion. Here is the thing that very few people understood at the time. You did not even need money to get into the stock market. Brokers offered everyday Americans generous loans to buy stock. This practice was called buying on the margin. The mechanics were simple. Put down 10% of a stock's value in cash. Borrow the rest from your broker. Wait for the price to rise. So, pay back the loan. Keep the profit. It was intoxicating. People mortgaged their homes, risked their small businesses, poured their life savings into the Wall Street machine. And why not? Everyone said it was a sure thing. Unless, of course, there was a margin call. The fatal flaw was hidden in plain sight. The stock itself served as collateral for the loan. If the stock's value dropped even slightly, the investor's 10% deposit vanished. The broker would then issue a margin call. Immediate repayment. In cash. No exceptions. Most investors could not find that cash. So they were forced to sell their stocks at a loss. Just to cover the debt. But ordinary investors were not the only ones drowning in borrowed money. Businesses had borrowed heavily to expand. Families had bought radios, washing machines, and automobiles on installment plans. Henry Ford offered the Model T on credit. Auto sales exploded. And so did the steel, glass, and rubber industries behind them. The entire American economy was running on borrowed time. Nowhere was the crisis more fragile than on the American farm. During World War I, the government urged farmers to produce as much as possible. Farmers borrowed heavily. They bought land. They bought tractors and harvesters. After the war, that enormous production capacity flooded the market. Prices fell. Farms could not earn enough to repay their debts. Banks began to worry. By late 1929, the Federal Reserve Bank of New York was alarmed. To cool the frenzy of margin buying, they raised lending rates. But this had an unintended consequence. Central banks across Europe felt forced to match the new rate. Nations already devastated by World War I were pushed into severe recession. The cracks were spreading. Quietly. Invisibly. Everywhere at once. In early October, a few brave analysts broke the silence. They warned the market was dangerously overvalued. The warnings triggered violent shocks. But the market always seemed to recover. Just before closing, the illusion held firm. Until October 24, 1929. Black Thursday. The opening bell had barely rung before chaos erupted. Within minutes, the market lost 11% of its value. On the trading floor, men shoved each other. They screamed until their voices gave out. Everyone was trying to sell. Trades flew so fast that the stock ticker fell hours behind. Brokers in Chicago and California were making decisions based on prices that were already 4 hours old. They were trading blind. Outside on the streets, massive crowds gathered. Wild rumors spread through the city. People whispered that ruined stockbrokers were leaping from the windows of the financial district. These reports were mostly false. But the terrified public believed every word. Inside a smoke-filled back room, the titans of American banking gathered. Chase National Bank, Morgan Bank, National City Bank. They remembered 1907, when J.P. Morgan himself had injected cash and stopped a panic. They decided to try the same move. They pooled their resources and handed the money to Richard Whitney, vice president of the New York Stock Exchange. Whitney walked onto the frantic trading floor. With total confidence, he made a massive, very public purchase of U.S. Steel, at a price well above market value. Then he did the same for a dozen other major companies. It was theater. A display of absolute faith in the market. And for one brief moment it worked. By the closing bell, the Dow had lost only 6 points. The bankers exhaled. But the nightmare was only taking a breath. Over the weekend, the margin calls went out. All across America, telephones rang. Dinner cooks, factory workers, farmers, busboys. They picked up the receiver and heard a cold, professional voice on the line. You owe the bank money. It is due immediately. The amounts were devastating. $500. $1,000. Sums that a working family in 1929 could not produce. Not if they sold their car. Not even if they sold their home. But people tried. Because they had to. October 28th. Black Monday. The opening bell signaled pure pandemonium. Men threw punches on the trading floor. Everyone needed to sell. Not wanted. Needed. Brokers were dumping their clients' stocks by force. The margin calls had gone unanswered. The difference between selling now and selling 30 minutes later could mean losing another 10% of everything you owned. By closing, the Dow had dropped another 13%. And then came October 29th. Black Tuesday. The day the roaring 20s officially died. The market would not stop falling. Physical fistfights broke out. Men watched their fortunes disappear in real time, trade by trade, minute by minute. The ultimate horror of Black Tuesday was this. Everyone was screaming to sell. But there was no one left to buy. The numbers kept going down. Down into the abyss. Shell-shocked traders stared at each other in silence. Worthless trading slips fell from their pockets onto the floor. Some papers were so utterly worthless, they were simply left to be swept up with the trash. In just 2 days, the market had lost 23% of its value. A last emergency purchase by the banking consortium produced 1 day of recovery. Nothing more. The illusion was dead. The Dow then began a slow, grinding collapse that would not hit bottom until mid-1932. By then, the Great Depression had fully arrived. The crash and the depression were not exactly the same event. But the crash shattered consumer confidence and wiped out the savings of millions of ordinary Americans. Within a few years, Henry Ford's assembly lines ground to a halt. Unemployment in Detroit reached 34%. Half of all construction workers in the country lost their jobs. In Washington, the U.S. Army deployed tanks and tear gas against World War I veterans who had marched to demand their promised pensions. On the Great Plains, catastrophic dust storms turned the sky black at noon. In New England, the snow fell red. It was a decade of disasters. Ecological, financial, and deeply personal. All of it heralded by the ringing of one bell on one October morning in 1929. The Great Crash reminds us how fragile wealth truly is. When the illusion of prosperity breaks, it is always the working class who feel it first. Today, with record consumer debt and markets at all-time highs, one question echoes across the decades. Are we living on another permanently high plateau? Leave your thoughts in the comments below. And if this story moved you, subscribe. More forgotten chapters of American history are waiting.